Welcome to StudyVix YouTube channel. Always study smart and master your future.
It's an essential mission, and today, for every learner focused on excelling in corporate compliance, we are diving deep into one of the most critical and complex pillars of the Companies Act 2013.
We certainly are. We're talking about the entire legal framework surrounding audit and auditors.
That's right.
Absolutely. Today, we are undertaking a comprehensive audio lecture that really forms the cornerstone of corporate accountability. That's Chapter X of the Companies Act 2013.
And we'll be systematically covering sections 139 right up to 148.
Yes, and making sure we integrate every nuanced detail from the accompanying companies' Audit and Auditors Rules 2014.
And this isn't just, a recitation of rules. This is essential knowledge for anyone dealing with corporate finance.
I agree.
Our goal in this audio lecture is to fully comprehend the sophisticated legal architecture governing auditors.
So we'll dissect their appointment rules.
The strict tenure limits, the immense powers they hold, the non-negotiable duties they have to fulfill, and of course, the severe restrictions and penalties that ensure their independence remains paramount.
That's the real takeaway here, isn't it? We are understanding the mechanics of how the law mandates transparency. We're figuring out how this entire legal structure ensures that the financial statements, which are the bedrock of trust for investors and creditors, truly reflect a true and fair view of the company's financial health.
What is truly fascinating and, critical for you to grasp is the underlying legislative intent here.
Right.
The entire structure of the Act, from Section 139 onwards, is meticulously designed to safeguard auditor independence.
Because it recognizes a potential conflict.
It recognizes explicitly that directors, despite holding a fiduciary role, represent management. And because of that, they require a professional, independent check and balance.
And that check and balance is the auditor.
Exactly. That auditor, who is appointed by the shareholders, is the ultimate representative of the members.
Okay, let's unpack this monumental task, starting right at the beginning. Section 139, the foundation of the auditor's relationship with the company.
The core principle here, as you said, is that the members appoint auditors to provide that independent professional opinion on the company's financial affairs.
So, to start, you must distinguish between two scenarios, right? The very first auditor and then all the subsequent ones.
Precisely. Let's start with the first one.
Let's clarify that first appointment. Who handles that initial step?
For the first auditor of a company, the responsibility rests with the board of directors.
And they have a deadline.
They do. They must make that appointment within 30 days of the company's registration. If the board fails to do that,
Then the members step in.
the members step in. Exactly.
And then the more common, enduring scenario, the subsequent auditor.
Right. So subsequent auditors are appointed by the members, the shareholders, at the company's first annual general meeting, or AGM.
And this is a really crucial point for exams. This appointment is not an annual event.
It's not. That auditor holds office from the conclusion of that first AGM right until the conclusion of the sixth AGM.
So a 5-year term, essentially.
A 5-year term. And that sixth AGM tenure is a highly examinable point because it defines that initial term limit.
Now, once that auditor is appointed, who guides the selection process, particularly in larger, more complex organizations?
That's where the audit committee comes in, under Section 177.
Right.
For certain classes of companies, typically listed companies, and those meeting specific thresholds for paid-up capital or turnover, the company has to constitute an audit committee.
And this committee is the first line of governance in this whole process.
It is. Their primary role is to recommend the auditor to the board of directors.
Okay, now here's where internal accountability is really tested. What happens if the board of directors disagrees with the audit committee's recommendation?
This is a brilliant mechanism in the Act.
Let's use an example. Say Surya Solar Limited. The committee recommends KPM and Associates, but the board is skeptical.
Right. So this procedure is designed to force reasoned deliberation. If the board disagrees, maybe they feel KPM and Associates lacks experience in renewable energy, the law mandates they must first refer the recommendation back to the committee for reconsideration.
They can't just reject it outright.
They cannot. They have to cite their precise reasons for the disagreement.
So the board essentially says, we challenge your rationale, think again. What if the audit committee stands firm?
Good question. If the audit committee reviews the board's concerns but decides not to change its mind, so they insist on KPM and Associates,
Then what?
then the board has to handle this friction transparently. They must record, in writing, their reasons for disagreeing with the committee.
And then it goes to the shareholders.
Then, when the company sends out the notice for the AGM, the board must send both the audit committee's original recommendation and its own reasons for disagreement, along with its own preferred recommendation, to the members.
So the ultimate decision still rests with the shareholders at the AGM. But the law ensures they have a full, documented view of the internal corporate struggle over the auditor selection. That's accountability in action.
Precisely. This mechanism prevents management, acting through the board, from just overriding the governance structure of the audit committee without transparently exposing that conflict to the ultimate owners, the members.
Okay, let's pivot to the aspect that most dramatically changed the auditing landscape: mandatory rotation and tenure limits.
Yes, a huge change in the 2013 Act.
Why introduce such strict limits on how long an auditor can serve?
The intent was to break the cycle of overfamiliarity. When an auditor or a firm stays for decades, the professional relationship can become, let's say, too cozy.
And that could compromise skepticism and independence.
Exactly. The law introduced a hard stop to force fresh eyes onto the company's accounts periodically.
So what are those strict limits on consecutive terms? This is a mandatory exam point, so let's be clear.
Okay, for an individual chartered accountant, they can serve for only one term of 5 consecutive years.
Just one term.
One and done. However, for an audit firm, which can rotate partners internally, they're permitted to serve for 2 terms of 5 consecutive years.
So a total of 10 years maximum.
A maximum of tenure.
The moment that maximum tenure is reached, 5 years for an individual, 10 for a firm. What happens next?
The mandatory cooling period kicks in.
And how long is that?
This break must be 5 continuous years. During those 5 years, that individual auditor or audit firm is completely ineligible for reappointment in that company.
They have to engage a completely new auditor.
A completely new, unrelated firm.
This sounds straightforward, but we know audit firms can be clever.
Yeah.
They might just set up a new firm with a slightly different name, but the same key people.
And that's where the common partner restriction comes in. The law anticipates this.
Right. Let's dissect that using the example of Ms. Krishna's associates and Ms. Kukreja and associates, who share Mr. Shyam as a partner.
This specific provision is designed to prevent exactly that kind of indirect circumvention of the cooling period.
So how does it work?
The law states that a succeeding audit firm cannot be appointed if, on the date of appointment, it shares a partner with the previous audit firm whose tenure just expired.
Until that 5-year cooling period is complete.
Is fully completed.
Okay, so let's apply that to the example. Mrs. Krishna and associates completed its full 10 years. They're now in their 5-year cooling period.
Right. And Mr. Shyam was a partner there. He's also a partner in the potential successor firm, Ms. Kutraj and Associates.
He's the common link.
He is. And because he's the common link, the law views Mrs. Kukreja and Associates as essentially the same auditing force as Krishna and Associates.
So they are also disqualified.
They are ineligible for appointment until Krishna and Associates' cooling period expires. They have to wait the full 5 years.
So the law looks beyond the firm's brand and focuses on the responsible individuals, the CAs who actually sign the reports.
It's a very targeted measure to enforce the spirit of the rotation rule, not just the letter.
And what if a company uses joint auditors?
Good point. Rule 6.4 ensures that rotation still achieves its goal without creating sort of institutional memory loss.
How does that work? A staggered rotation.
Exactly. If a company appoints multiple joint auditors, they must be rotated in a staggered manner. The rule requires that not all joint auditors can complete their maximum tenure in the same financial year.
So there's always some continuity.
Always. There's always at least one experienced auditor firm retained, providing that continuity during the handover.
Finally, let's address the regulatory giant in the room, the NFRA, or National Financial Reporting Authority. What are the requirements for communicating auditor appointments to this body?
The NFRA rules impose 2 distinct filing requirements in Form NFRA 1, and you need to know both timelines perfectly.
It's the first one.
First, there was a historical requirement for existing bodies corporate. They had to inform NFRA about their auditor within 30 days of the rules commencing. This was a one-time snapshot.
Okay, and for the companies that are actively governed by NFRA rules today, like listed companies?
For anybody corporate currently governed under NFRA rules, the filing requirement is proactive. They must inform NFRA in Form NFRA 1 within 15 days of the auditor's appointment under Section 139(1).
A much shorter window.
Much shorter. It reflects the high degree of regulatory scrutiny these specific companies are under.
Yeah.
So remember, 30 days for the initial transitional filing, 15 days for a current appointment under the rules.
We've covered how auditors get appointed and the maximum time they can serve. Now we turn to Section 140, which deals with what happens when that relationship ends prematurely.
And if the law builds safeguards around appointment, it creates an absolute fortress around removal of an auditor before term expiry.
That is the perfect analogy, a fortress.
The removal process is intentionally difficult because an auditor's ability to criticize management freely depends entirely on their job security. Arbitrary removal destroys independence.
So it requires two mandatory non-negotiable legal steps.
The two key steps.
Step one is the decision by the owners. What is the role of the company members?
The company must pass a special resolution. This means 75% of the members voting must agree to the removal.
But that alone is not enough.
Not even close. That's just step one.
And step two, the real legal shield.
Before the company can even hold that general meeting to pass the special resolution, it must obtain the previous approval of the central government. This power is delegated to the regional director, or RD.
And if you skip this approval,
the entire removal is void. Void ab initio.
Let's detail the precise procedural roadmap and the deadlines. These are constantly tested.
Okay, the sequence starts with the board. The board must pass a resolution agreeing to seek the removal.
And then the clock starts ticking.
Immediately. Within 30 days of that board resolution, the company must file an application to the central government in Form ADT2 seeking permission.
The CG then reviews this, checking the reasons to make sure the removal isn't just punitive because an auditor was being too critical.
That's the whole point of the check. Only once the central government grants its approval can the company move to the next stage.
And what's that stage?
The company then has 60 days from the date of receiving that CG approval to hold a general meeting and pass the required special resolution.
And if they miss either of those windows, the 30-day or the 60-day one,
the process is invalid. They have to start all over again.
That friction is intentional. It ensures removal is reserved for genuine cases, not just professional disagreement. And this applies even to the first auditor, right? The one appointed by the board.
Absolutely. This is a common trap in exams.
Like in the example of Mr. Suresh, the first auditor of AB Limited.
Exactly. The company decided they didn't like his approach and tried to remove him just by passing a resolution without CG approval.
And that removal is invalid.
Completely invalid, because Section 141 governs all removals before the expiration of the full tenure, regardless of who initially appointed the auditor.
Okay, moving to the other side. The auditor voluntarily choosing to leave. Resignation and the resulting casual vacancy.
This is covered under Section 140, subsection 2.
What is the non-negotiable statutory obligation on an auditor who resigns?
The auditor must file a formal statement in Form ADT3 detailing the reasons and relevant facts of their resignation.
And who does that go to?
It must be filed with both the company and the Registrar of Companies, the ROCE. The deadline is extremely strict, within 30 days of the date of resignation.
If the auditor serves a government company, are there additional bodies that need to be informed?
Yes. The scrutiny is higher. If the resigning auditor served a government company, they must also file that statement in ADT3 with the Comptroller and Auditor General of India, the CAG.
Within that same 30-day window.
Same 30-day window.
Why is this filing so crucial? And what's the consequence if the auditor misses that deadline?
It's crucial because the regulator needs immediate notice, especially if the resignation is due to disagreements over financial reporting.
And the penalty?
The penalty is targeted at the auditor. They are liable to a penalty of $50,000 or an amount equal to their remuneration, whichever is less.
A clear incentive for prompt compliance.
Absolutely.
Now, once the resignation is filed, the company has a casual vacancy. How does the company legally fill that spot? Let's use the example where Mr. Raman resigned, and the board wants to appoint Mr. Albert.
Okay, if the vacancy arises due to resignation, the board is authorized to fill it. They can appoint Mr. Albert.
But their appointment is provisional.
It is. It recognizes the member's ultimate right to appoint the auditor. Therefore, the board's appointment must be approved by the members by passing an ordinary resolution at a general meeting.
And what's the timeline for that meeting?
The board must convene that general meeting within 3 months of their recommendation.
And once Mr. Albert is approved, he holds office until?
Only until the conclusion of the next scheduled annual general meeting. This ensures the long-term choice of auditor reverts back to the members as soon as possible.
Before we leave removal, we have to talk about the rights of a retiring auditor who is facing replacement. The concept of special notice.
Yes, Section 144. This is about fairness.
So what's the first step the company must take?
The company has an immediate legal duty. It must send a copy of that special notice to the retiring auditor forthwith.
This gives the retiring auditor a chance to defend themselves or explain their perspective, right?
Exactly. The retiring auditor has the right to make a written representation, provided it's of a reasonable length, detailing their position.
And the company has to share this with the members.
They must. They have to notify members of the representation in the meeting notice and send a copy to every member.
But what if the representation arrives just hours before the notice is mailed, or the company delays sending it?
If the copy can't be sent because it was received too late or because the company defaulted, the auditor has another right.
Which is?
They can require that the representation be read out loud at the general meeting.
So it still gets heard.
It still gets heard, and a copy must be filed with the registrar. However, the tribunal, the NCLT, can step in if it feels these rights are being abused just to get undue publicity.
Okay, finally, let's discuss the ultimate regulatory hammer. Section 140, subsection 5. NCLT intervention for fraud.
This is reserved for the most severe cases of corporate malfeasance.
So when does the tribunal step in?
If the tribunal is satisfied that the auditor has acted fraudulently or has abetted or colluded in any fraud, it can direct the company to change its auditors.
And who can initiate this action? Can the NCLT do it on its own?
It can. It can act suo motu, on its own motion, or on an application by the central government, or even by any concerned person, like a shareholder.
The consequences for a fraudulent auditor go far beyond just losing that one client, don't they?
They are career-ending. First, the NCLT orders the change. Second, the fraudulent auditor is automatically ineligible to be appointed as an auditor of any company for a period of 5 years from the date of the NCLT order.
A nationwide ban.
A nationwide ban. And beyond that professional ban, they face criminal charges under Section 447 for fraud. The law is very, very clear.
Let's move on to Section 141. This is the gatekeeper section, right?
Yeah.
It defines who can be an auditor and, more importantly, who can't.
Exactly. It lays down the qualifications and, critically, the disqualifications that enforce the independence we keep emphasizing.
So the starting requirement is foundational.
It is. The auditor must be a chartered accountant with a certificate of practice. If it's a firm, only the partners who are CAs can act and sign the audit report.
Now let's get into the weeds of conflicts of interest. The disqualifications in Section 141(3) are where the law really tests independence. Let's start with the specific monetary limits.
The law sets 2 distinct quantitative limits to see if the financial relationship is too close for comfort.
First, the direct indebtedness limit.
A person, their partner, or their relative is disqualified if they're indebted to the company or its group structure, so its subsidiary, holding, associate company, for an amount exceeding 5 lakh.
5 lakhs, that's a key number to remember.
It is. And the second threshold relates to providing guarantees.
What's the limit there?
The auditor, their relative or partner, is disqualified if they've given a guarantee or provided security for a third person's debt to the company if that guarantee exceeds 1 lakh.
So 5 lakh for personal debt, 1 lakh for third-party guarantees.
That's the one. The reasoning is clear. If you owe the company significant money, you're not professionally free to issue a critical opinion. Your judgment might be compromised.
What about holding security or interest? This rule focuses squarely on the auditor's relative.
It does. A person is disqualified if their relative holds any security or interest in the company.
Any at all.
Generally, yes, but there's a critical escape clause. If the relative acquires security that exceeds 1 lakh in face value, the auditor is given a window of 60 days to take corrective action.
So they have 2 months to fix it.
They have 60 days to get that holding back below the 1 lakh limit. It's a grace period that reflects practicality. But failure to fix it within 60 days means instant disqualification.
Next, the broadly defined concept of a business relationship. How does the law restrict this?
The law disqualifies an auditor that has a direct or indirect business relationship with the company. And business relationship is defined very broadly as any transaction for a commercial purpose.
But that could disqualify an auditor just for buying a plane ticket from an airline they audit. There must be exceptions.
Of course. There are 2 vital common sense exclusions. First, professional services specifically permitted under the CA Act and the Companies Act.
So, the audit itself.
The audit itself and other allowed certifications. Second, and this is the airline example, it excludes commercial transactions that are in the ordinary course of the company's business and are conducted at an arm's length price.
So as long as the audit partner is paying the same price for the ticket as any other customer, it's fine.
Exactly. The law doesn't want to interfere with standard customer relationships, only those that create dependence or provide a special benefit that could compromise independence.
And finally, disqualifications based on illegal history or conflicts.
Two big ones here. A person convicted of an offense involving fraud is disqualified for 10 years after the conviction.
A long-term integrity check.
And critically, a person or firm is disqualified if they are currently rendering directly or indirectly any service listed in Section 144, the list of forbidden non-audit services.
Which brings us perfectly to our next topic. We transition now to Section 142 on remuneration, and then the big one, Section 144 on prohibited services.
Right. Section 142 is about the paycheck. Who holds the ultimate power to fix the auditor's fee?
So who is it?
Generally, the remuneration is fixed by the company in the general meeting. By the members.
But not always.
Not always. The initial fee for the first auditor or the fee for an auditor filling a casual vacancy is fixed by the board of directors.
The law also defines what that remuneration includes and excludes. What's in?
Remuneration includes the fee, of course, but also any expenses incurred by the auditor in connection with the audit, so travel, accommodation, other out-of-pocket expenses.
And what's the crucial exclusion under Section 142?
Remuneration does not include payment made to the auditor for any other service rendered by them.
So if they do a separate tax certification, that's a separate fee.
A completely separate fee. The law wants to maintain a clear distinction between the fee for the statutory obligation and the fee for other permissible work.
Okay, now let's tackle the most famous list in this entire chapter. Section 144, the forbidden list. What services are so compromising that the statutory auditor absolutely cannot render them?
This list is built entirely around the concept of a self-review threat. The auditor cannot perform any service that would result in them auditing their own work.
So let's walk through the 9 categories.
First, accounting and bookkeeping services. Obvious one. If they prepare the books, they can't audit them.
Makes sense.
Second, internal audit. The statutory auditor has to check the effectiveness of internal controls, which includes the internal audit function, so they can't perform it themselves.
Right. What's third?
Design and implementation of any financial information system. If you design the system that generates the numbers, you can't independently verify those numbers.
Okay. Number 4.
Actuarial services. These are complex calculations for things like pensions or insurance reserves, which must be independently audited.
5 is investment advisory services.
Right. You can't advise the company where to invest and then audit the result of those very investments.
What about investment banking?
That's number 6. Same logic. Advising on mergers or acquisitions creates a deep conflict.
Okay, number 7.
Rendering of outsourced financial services. Basically, you can't run the finance function for them.
Number 8 is a broad one, management services.
Very broad. It prevents the auditor from stepping into any kind of managerial role.
And finally, number 9.
Any other prescribed service. Currently, nothing else has been prescribed, but the law leaves room to add to the list.
So if a board asks its statutory auditor to design a new financial information system and the auditor accepts, what's the immediate legal fallout?
The fallout is severe and immediate. By accepting, the auditor directly violates Section 144. That triggers disqualification under Section 141, and it attracts penalties under Section 147.
So the auditor must refuse.
Must refuse. Independence is not negotiable.
And that critical regulatory phrase, directly or indirectly. If the audit firm can't do internal audit, can its subsidiary do it?
No. The law closes that loophole entirely. The prohibition extends far beyond the audit firm itself.
So it covers the whole network.
The whole network. Partners, relatives, parent companies, subsidiaries, associates, any entity using the firm's name or brand. It's a comprehensive ban to protect the entire audit relationship.
Section 143 is where the rubber meets the road. This outlines the legal authority the auditor needs and the mandatory items they must certify in their report. What are their foundational powers?
2 main pillars. First, the right to seek and obtain all necessary information and explanations from the company's officers. Management cannot stonewall them.
And second?
The right to access the company's books of accounts at all reasonable times.
Okay, moving to the audit report itself. Section 143.3 lays out specific duties. What are the mandatory checks the report must cover?
The report has to explicitly state a few things. 1, whether all necessary information was obtained. 2, whether proper books of account were kept.
And there's one about the IEPF.
Yes. A specific report on whether amounts required to be transferred to the Investor Education and Protection Fund have been done so without delay.
Now let's zoom in on the incredibly complex anti-fraud reporting requirements. This targets sophisticated, opaque funding structures.
This clause is highly technical. It requires auditors to look for transactions where management has represented that funds were either advanced or received under a sort of disguised arrangement.
Let's break down the two sides of the transaction. First, when the company advances money.
The auditor checks if the company has advanced funds to a party, let's call them the intermediary, with the understanding that the intermediary would then lend or invest those funds in other identified parties, the ultimate beneficiaries.
So using a middleman to hide the funding trail.
Precisely. And the other side is when the company receives funds from a funding party with the understanding that the company would then pass those on to an ultimate beneficiary.
And the purpose is to conceal related party transactions or something worse.
Exactly. The auditor's role isn't to prove fraud, but to report if they believe the management's representations about these arrangements contain any material misstatement.
Okay, two more recent critical compliance items. First, dividend compliance.
The report must state whether the dividend declared or paid complies entirely with the strict requirements of Section 123.
And the second, a major technological shift, is the use of the audit trail software.
This is huge for digital accountability. The auditor must report whether the company's accounting software has an edit log or audit trail feature.
And not just whether it has it.
But whether it was operated throughout the year, whether it was tampered with, and whether the records have been preserved as per statutory requirements. It makes it impossible to change transactions retroactively without leaving a trace.
Now, the critical auditor's duty to report fraud under Section 143.12. This is a heavy compliance duty. What is the protocol?
It's a strict two-tiered reporting system. If the auditor has reason to believe a fraud has been committed, they must immediately report it to the board or the audit committee.
Then they wait for a response. For how long?
They wait for 45 days for the board or committee to investigate and reply.
And what if they don't respond, or the response is unsatisfactory?
Then the auditor must forward the report directly to the central government. That's the ultimate escalation.
Who is the final recipient at the central government?
The report goes to the Secretary, Ministry of Corporate Affairs, and the submission is very formal, in a sealed cover by a registered post or speed post, followed by an email confirmation.
The penalties for not doing this are severe.
They are. A penalty of 5 lakh for a listed company and 1 lakh for any other company.
What if management identifies the fraud first and tells the auditor? Does that relieve the auditor of their duty?
Absolutely not. The auditor's duty under 143 and 12 is statutory and non-negotiable. Even if management is aware, the auditor must still follow the formal reporting protocol to the regulators.
Finally, what about the special oversight for government companies?
For any government company, the ultimate authority is the Controller and Auditor General of India, the CAG.
And what can the CAG do?
The CAG has the right to conduct a supplementary audit or to comment upon the original audit report. They have 60 days from receiving the report to do this.
We've established the duties. Now let's confirm the execution and oversight. Section 145 confirms who legally signs the audit document.
Section 145 just reiterates the core eligibility. If it's a firm, the report must be signed by the partner or partners who are chartered accountants.
And Section 146 details the auditor's involvement in general meetings. What is the company's legal requirement?
The company has an absolute obligation to serve notice of any general meeting to the auditor. Failing to do so is a contravention of the Act.
And the auditor's corresponding duty. Must they attend?
They shall attend, unless the company explicitly exempts them. They can attend personally or through an authorized representative who must also be qualified to be an auditor. Their presence allows them to answer shareholder questions.
Next, Section 148 introduces a hard segregation of duties between statutory audit and cost audit.
A crucial distinction. The person or firm appointed as the statutory auditor under Section 139 cannot be appointed for conducting the audit of cost records, and vice versa.
Two separate firms.
Two separate, distinct firms.
Okay.
It maximizes independence.
And the central government retains oversight of the cost audit report as well.
Yes. The company must file the cost audit report with the central government, which can call for further information if needed.
Finally, let's detail the extensive oversight capabilities of the ultimate policing authority, the NFRA. What powers does NFRA hold?
NFRA's mandate is to monitor, enforce, and improve audit quality for large public interest entities. They have sweeping powers.
Such
They can review working papers, evaluate the auditor's quality control system, and even perform their own testing of the auditor's procedures. They are essentially auditing the auditors.
And they can demand personal presence, right?
That's correct. They can require the personal presence of the auditor or any partner to provide explanations. If any violation is found, NFRA initiates enforcement action.
How public are their findings?
Under Rule 8, NFRA shall publish its findings of non-compliance on its website. It's a key part of their deterrent function.
And Rule 9 gives NFRA the power to actively mandate improvements.
Absolutely. It can direct an auditor to take specific measures to improve their audit quality, change processes, and then the auditor must report back on implementation.
What about ongoing compliance? Is there an annual filing?
Yes. Every auditor governed by NFRA rules must file an annual return in Form NFRA 2. The deadline for this is November 30th every year.
That concludes this exhaustive audio lecture detailing the entire legal framework of audit and auditors under the Companies Act 2013. Let's briefly synthesize the absolute must-know facts for your revision.
Concentrate on the strict time limits and monetary thresholds. You have to master the rotation rules. 1 term of 5 years for individuals, 2 terms of 5 years for firms, and that mandatory 5-year cooling period.
And remember the common partner restriction that stops them from getting around that rule.
Exactly.
Crucially, internalize the strict legal hurdles for removal. That 2-step process requiring central government approval before a special resolution can be passed. And remember, the 30-day deadline for filing Form ADT3 upon resignation.
And do not confuse the independence thresholds in Section 141, the ERO lack limit on personal indebtedness versus the WERN lack limit on providing guarantees.
Right.
And you must be able to list and identify all 9 prohibited services under Section 144. Taking up any of those jobs instantly disqualifies the statutory auditor.
Mastering these sections isn't just about passing an exam, it's about understanding the high standards of integrity and independence required to operate in the corporate world.
We've clearly seen the robust structure, the severe penalties, and the overwhelming regulatory power vested in NFRA and the NCLT. This system is designed to police every aspect of the auditor-client relationship.
Which brings us to a final thought.
Right. Given the sheer size of global audit firms, the Big Four, and their necessity for complex global businesses, this raises a final, provocative question for you to consider.
And what's that?
Despite the legal rigor of Section 144 and mandatory rotation, does the current framework fully address the systemic risk associated with these firms becoming so integrated into the corporate ecosystem that their failure or their compromised judgment in a major client could create a risk that is too big to fail for the entire financial market?
Keep reflecting on the spirit of independence versus the practical realities of a concentrated global audit industry. That is all for this essential audio lecture into the Companies Act. We'll see you next time on StudyVix.
Don't forget to like and subscribe.